3 dates. Mark them. December 27th, 2025. January 26th, 2026. March 26th, 2026. These aren't predictions. These aren't technical levels drawn on a chart. These are the 3 windows where the mathematical pressure building inside the silver market reaches critical mass, where decades of price suppression collide with physical reality, where paper contracts face delivery obligations they cannot meet, and where the gap between what COMEX promises and what actually exists in the vaults becomes undeniable. One of these 3 dates could trigger the break. The moment silver stops trading as a commodity and starts trading as a crisis. When the price doesn't rise, it gaps. When premiums don't increase, they explode. When the system doesn't adjust, it fails. In the next 15 minutes, I'm going to show you why these 3 dates matter. I'll walk you through the mechanics at each window. The backwardation in India's MCX market that's screaming physical shortage. The COMEX futures evaporation as shorts desperately avoid December delivery. The LBMA delays on shipments to India that confirm the physical supply chain is breaking. And the 5-year supply deficit that's drained every buffer in the system. By the end, you'll understand why December 27th is the first shock window, why January 26th could trigger the mini-squeeze, and why March 26th is the unavoidable endgame when the shorts have nowhere left to run. This isn't hype. This is pressure. Building. Visible. And about to release. Let's start with what's happening right now that sets up all 3 dates. The COMEX futures rollover. In December 2025, something unprecedented happened. December silver futures, which typically see steady delivery activity, collapsed. Now, why is December terrifying to shorts? 2 reasons. Year-end balance sheets and Indian demand. December is fiscal year-end for most institutions. Banks close their books. Regulators review positions. Shareholders scrutinize holdings. Nobody wants a massive delivery obligation sitting on their balance sheet on December 31st. It's a liability. It requires capital reserves. It invites questions. So banks pressure traders to roll, to close, to avoid delivery. But on the other side, December is also when Indian demand peaks. India is the world's largest silver importer, over 200 million ounces annually. And December through January is wedding and festival season. Diwali, Dhanteras, weddings. Indians buy silver jewelry, coins, bars as gifts and investments. Physical demand surges. And this year, 2025, Indian demand is extreme. Not normal seasonal demand, panic demand. Let me show you what's happening in India's MCX market, the multi-commodity exchange of India. This is where silver futures trade in India. And the MCX is showing extreme backwardation. Backwardation means the spot price is higher than the futures price. Immediate delivery costs more than future delivery. This is the opposite of normal market structure. Normally, futures trade at a premium to spot. Why? Because storing and financing metal costs money. You pay to hold silver for 3 months. So March futures should cost more than December spot. But in India right now, December spot silver is trading at a premium to March futures. Spot is 95,000 rupees per kilogram. This backwardation is screaming shortage. And it's not just India. The LBMA, London Bullion Market Association, is experiencing the same tightness. Reports from Indian importers indicate 30-day delays on silver shipments from London. Orders placed in November are arriving in late December or January. That never happened before. London is supposed to have deep vaults, massive inventories, but they're struggling to fulfill Indian orders. Why? Because LBMA vaults have been draining for 5 years. In 2020, LBMA held over 1 billion ounces of silver. In 2025, it's under 750 million. That's a 25% decline, and the drawdowns are accelerating. In 2025 alone, LBMA lost over 100 million ounces. Some went to industrial users, some went to COMEX to cover delivery stress, some went to India to meet import demand. But it's not being replaced. Mine supply is flat. Recycling is low. The vaults are draining. And now they can't ship to India on time. That's physical breakdown. So here's the setup for December 27th, the first critical date. December 27th is the last trading day before year end. It's when December futures expire. It's when delivery notices must be finalized, and it's when the year-end squeeze window opens. Here's the scenario. Indian demand is surging. MCX backwardation is extreme. Physical premiums in India are $3 to $5 per ounce over COMEX spot. Indian importers are desperate. They need silver for January wedding season. They're bidding aggressively. Meanwhile, COMEX shorts have rolled most of their December positions to March, but some contracts remain. 30,000 contracts, 150 million ounces. If even 5% of those stand for delivery, that's 7.5 million ounces. COMEX registered silver is 152 million ounces. But the deliverable float, the metal that can actually move, is 15 to 20 million ounces. A 7.5 million ounce delivery request is manageable. Barely. But if it coincides with Indian panic buying, if physical demand spikes simultaneously, the pressure compounds. Here's the catalyst. December 27th, a large Indian importer or industrial user announces they're taking delivery on 2,000 COMEX contracts. That's 10 million ounces. It's legal. It's their right. They own the contracts. But COMEX doesn't have 10 million ounces immediately available. They have to source it, pull from registered, ship from other vaults. It takes time, days, maybe weeks. And during that time, the market realizes COMEX is tight. Other longs smell blood. They demand delivery too. Suddenly, 5% becomes 8%. 8% becomes 12%. The requests cascade. And COMEX faces the choice. Deliver and drain the vaults to dangerously low levels, or force cash settlement and admit they can't deliver. Either way, the market reacts. Silver gaps from $33 to $40 overnight. Physical premiums in India spike to $8 to $10 over spot. MCX backwardation widens to 5%. The first shockwave hits. Now, does this definitely happen on December 27th? No, it's a window, a probability. The setup is there. Indian demand is real. MCX backwardation is documented. COMEX registered is constrained. But the trigger, a large delivery demand, is uncertain. If it doesn't happen December 27th, the pressure rolls to the next window. January 26th, 2026, the second critical date. January 26th is 1 month after year end. It's when fiscal reporting is done, when balance sheet pressure eases, when institutions have reset positions, and it's when Indian demand peaks. January is the height of wedding season. Silver imports into India hit maximum levels. And if December was tight, January is tighter. Here's why. The LBMA delays from December haven't resolved. Shipments ordered in November are still arriving. New orders placed in December won't arrive until late January. Indian vaults are running low. Jewelers need metal. Mints need metal. Industrial users need metal. And they're all bidding for the same limited supply. Meanwhile, COMEX February futures are the active contract. And if the December rollover pattern repeats, February will see aggressive rolling into March as well. The shorts continue avoiding delivery, pushing obligations forward. But each time they roll, the cost increases, the spread widens. March futures trade at a premium to February. Rolling costs money, bleeds capital. And eventually, some shorts can't afford to roll anymore. They're forced to cover, to buy back their positions. And that buying pressure drives the price higher. So January 26th becomes a mini squeeze window. Not the final squeeze, but a violent spike, a gap from 40 to worry to $55 or $60. Physical premiums in India hit 12 to $15 over spot. COMEX registered inventory drops below 140 million ounces. The vaults are visibly draining, and the market starts pricing in March as the endgame. But here's the key. December and January are mini squeezes, shock windows, they're symptoms. The disease is March 26th, 2026, the third and final date. This is not a window, this is the event. March is when the accumulated pressure releases. March open interest is 95,000 contracts and climbing. By expiration, it could reach 100,000 to 110,000 contracts. That's 500 to 550 million ounces of paper claims. COMEX registered silver will likely be under 140 million ounces by then. The deliverable float, 12 to 15 million ounces. If 5% of longs stand for delivery, 25 to 27 million ounces requested. COMEX can't deliver. The shortfall is 10 to 12 million ounces. If 10% stand for delivery, 50 to 55 million ounces requested. The shortfall is 35 to 40 million ounces. The system breaks, not bends, breaks. March 26th is unavoidable. Why? Because the shorts have run out of room to roll. December rolled to March, February will roll to March. March is the deadline. You can't roll March into May without admitting defeat, without signaling to the entire market that you can't deliver. So March becomes the final stand. The shorts either deliver or they don't. And the math says they can't. So what happens? COMEX forces cash settlement. They invoke force majeure. They change the rules. They announce that physical delivery is impractical and all outstanding contracts will be settled at the prevailing price in dollars. Let's say silver is at $60 by mid-March. They settle the 40 million ounce shortfall at $60. That's $2.4 billion in cash payments. COMEX can handle that financially. But the credibility damage is terminal. Every industrial user realizes COMEX contracts are worthless. Every investor realizes paper silver is fraud. And the physical market decouples entirely. Physical premiums explode to $30, $40, $50 over spot. COMEX trades at $60. Physical silver in India trades at $110. In London, $100. In private deals, $120. The paper price becomes irrelevant. The real price is whatever physical metal actually trades for, and that price discovers itself through supply and demand. Not through futures contracts, not through COMEX manipulation, through miners selling directly to industrial users, through refineries allocating to long-term contracts, through central banks buying at any price. And that price could be $200, $300, $400. We don't know, because we've never seen the paper market completely break before. But March 26th is when it could happen, when the decades of suppression, the 100-to-1 leverage of paper to physical, the illusion of infinite supply, all of it collapses in a single event. Now let's talk about the 5-year supply deficit, because this is why the vaults are empty. Silver has run a structural supply deficit for 5 consecutive years. 2020, 2021, 2022, 2023, 2024. Every year, global demand exceeded global supply. The Silver Institute estimates the deficit at 125 to 200 million ounces annually, depending on the year. Where did that deficit come from? Existing inventories. In 2020, COMEX had 400 million ounces registered. LBMA had over 1 billion. Government stockpiles existed. ETFs like SLV held 650 million ounces. There was a buffer, a cushion. But 5 years of deficits drained it. COMEX is down to 152 million registered. LBMA is under 750 million. SLV is at 450 million, down 200 million from peak. Government stockpiles are gone. The U.S. Strategic Silver Reserve was depleted in 2002. There is no emergency supply, and the deficit is accelerating. Why? Industrial demand is surging. Solar panels consume 200 million ounces annually, up from 85 million in 2020. Electric vehicles use twice the silver of gas cars. EV production is growing 20% per year. 5G infrastructure, AI data centers requiring massive cooling systems, medical devices, electronics. Every modern technology consumes silver, and there's no substitute that matches efficiency. Meanwhile, mine supply is flat, 830 million ounces per year. It hasn't grown in a decade. Why? Because 70% of silver is a byproduct of copper, zinc, and lead mining. You can't just mine more silver, and base metal prices have been volatile. Mining investment is low. New projects take 7 to 10 years. There's no new supply coming. So every year, the gap between consumption and production grows, and the inventories drain. That's why COMEX is tight. That's why LBMA is delaying shipments. That's why India is in backwardation. The metal is gone. Here's the critical insight. The 3 dates, December 27th, January 26th, March 26th, they're not arbitrary. They're pressure points. Moments when the deficit, the vault draining, the physical shortage, all converge with delivery obligations. December is year-end and Indian peak demand. January is post-reset and continued Indian demand. March is the final delivery month with no room to roll. Each date is a potential trigger. A moment when one large delivery request, one industrial panic, one COMEX vault failure causes the system to break. And the probability increases at each date. December's 20%, maybe. January's 40%. Possibly March is 80% likely. By March, the math is unavoidable. The vaults are drained. The open interest is massive. The shorts are trapped. Something breaks. Now let's talk about the price targets. Because if one of these 3 dates triggers the break, where does silver go? Short term, $70. If December or January triggers a mini squeeze, silver gaps from $33 to $50 immediately. Then grinds to $60 over 2 weeks. Then spikes to $70 as shorts scramble to cover. That's the technical target. The bull flag measured move plus the 2011 high breakout. $70 is the first resistance where institutional algorithms trigger, where options strike cluster, where profit taking begins. But $70 is not the end game. If March triggers the full break, if cash settlements are forced, if physical decouples, the targets extend. Intermediate, $200 to $300. This is based on the physical premium over paper. If COMEX trades at $70 and physical premiums are $50 over spot. Physical trades at $120. If premiums widen to $100, physical is $170. If premiums hit $150, physical is $220. This range reflects severe shortage but not complete systemic failure. Long-term, $600 to $670. This is the cup and handle target from the 1980 high. It is the Fibonacci 2.618 extension from the 2001 low to the 2011 high, projected from the 2025 breakout. So what do you do with these 3 dates? First, mark them. December 27th, January 26th, March 26th. These are the windows, the pressure points. Watch the data around these dates. COMEX registered inventory, open interest, physical premiums. Backwardation. If registered drops below 140 million before December, the risk increases. If March open interest exceeds 100,000 contracts, the pressure is extreme. If physical premiums in India widen beyond $5, the shortage is acute. Second, position before December. If you believe one of these dates triggers the break, you need physical silver now, not at $50, not when premiums are $20 over spot. Now, at $33 with $3 premiums, availability is the constraint. When the break happens, you can't buy. Dealers sell out. Mints have 6-week delays. Premiums double. You're priced out. Third, understand the timeline. December is the first window. If nothing happens, pressure rolls to January. If January passes, March is the end game. You have 3 chances, 3 moments when the system could break. One of them likely will. Which one? The data will tell you as we approach. Fourth, don't wait for confirmation. When silver gaps from $33 to $50 overnight, when premiums spike to $15, when delivery failures are announced, it's too late. The break happens fast. By the time mainstream media reports it, physical is unavailable. You need to see it before it's obvious. That's the edge. Here's the brutal truth. These 3 dates exist because the silver market is broken. Has been for decades. Paper contracts trade at 100 to 1 leverage over physical. COMEX has sold 500 million ounces of paper silver, backed by 15 million ounces of deliverable metal. That's fraud. But it's legal fraud until someone demands a delivery, until the physical shortage becomes undeniable, until one of these 3 dates forces the system to admit it can't deliver. And when that happens, when cash settlements are announced, when physical decouples, when price discovery shifts from New York to Shanghai and Mumbai in private deals, the people holding paper contracts learn the lesson. Paper is not metal. Promises are not silver, and COMEX is not a commodity market. It's a casino, and the house always protects itself. If this opened your eyes to the 3 critical dates that could break the silver market, subscribe. Because I'm tracking every data point between now and March. Registered inventory daily, open interest weekly, physical premiums in India, LBMA shipment delays, MCX backwardation. When one of these dates triggers, when the pressure releases, you'll want to understand what's happening in real time. Next video, why the MCX backwardation in India is the most important silver signal nobody in the West is watching, and how it is predicting the COMEX break before it happens. 3 dates, December 27th, January 26th, March 26th. One of them breaks the market. The setup is perfect. The pressure is building, and the window to position is closing. Don't wait for the break. By then, it's too late.